Lately, you might have seen headlines about a guy named Peltz and something about a proxy fight. Well, there's more to this story than just a high stakes proxy fight. This could mark the beginning of significant shifts within Disney, affecting everything from leadership to what people are used to watching nowadays. As we all know, Peltz is a huge investor who is known for his ability to turn companies around. But many investors are unsure of his intentions with Disney. So, in today's video, we're going to delve into who Peltz is, his track record, and what his potential influence could mean for one of the world's most iconic entertainment giants. Without further ado, let's get into this complex and potentially game changing proxy war. Nelson Peltz is a billionaire investor with a penchant for shaking things up at big companies to make them more profitable. He started his career in New York by turning his dad's small produce delivery business into a booming enterprise. This experience laid the groundwork for his later ventures in the financial world. In 2005, he co-founded Trian Fund Management with Peter May and Ed Garden. Trian quickly made a name for itself. Their strategy involves finding companies with potential, but poor performance due to operational inefficiencies or bad decisions. Trian buys significant stakes in these companies and collaborates with management to improve efficiency and boost market value. One of Trian's early successes was with H.J. Heinz Company. Peltz and his team pushed for changes that improved operations and strategic focus, setting a precedent for future interventions. They also played a major role in companies like Kraft Foods, leading to the creation of Mondelez International and a more focused Kraft Foods Group. Trian's approach has consistently delivered results, with many of their portfolio companies outperforming their peers. Due to this, Peltz's ability to drive positive change in large corporations has earned him a reputation as a force for good in the corporate world. Now, armed with this reputation, Peltz sets his sights on a new target, none other than Disney itself. In early 2023, Nelson Peltz and Trian Fund Management made waves by investing around $3.5 billion in the Walt Disney Company. This was a shark move, as Peltz aimed to gain influence within Disney. By securing a substantial ownership stake, Trian positioned itself as a key player, intent on driving changes at this iconic entertainment giant. Peltz's main goal was to get a seat on Disney's board of directors. He believed that with a seat at the table, he could help steer the company in a better direction, addressing various operational and governance issues. The initial $3.5 billion stake set the stage for a high-stakes battle for control and influence, with many shareholders sitting on the edge, unsure of who to side with. The fight between Trian and Disney became a closely watched proxy battle, as Trian sought to leverage its substantial stake to bring about significant changes in Disney's corporate governance and strategy. In January 2024, Trian Fund Management escalated its proxy fight with Disney by releasing a detailed 35-page presentation titled Restore the Magic. This document was a cornerstone of Trian's campaign, laying out Disney's financial challenges. In Restore the Magic, Peltz highlighted several key issues. He criticized the high costs associated with Disney's streaming service, Disney Plus. Despite its success in gaining subscribers, content creation and platform maintenance costs was putting a heavy strain on Disney's finances. Peltz pushed for better cost management to make the streaming business profitable. Peltz also took aim at Disney's capital allocation strategies. He argued that the $71 billion acquisition of 21st Century Fox had yet to deliver the promised benefits and had instead burdened Disney with a large debt. He called for a reevaluation of Disney's investment strategies, focusing on more prudent spending to ensure better returns for shareholders. His critique extended to Disney's content strategy. He felt the company relied too heavily on legacy franchises and needed more innovation in new content. He believed Disney needed to diversify its offerings and take more creative risks to stay competitive. He also saw opportunities for better monetization of Disney's intellectual property. Trian's campaign gained momentum with the support of Institutional Shareholder Services and State Street, a major Disney shareholder. ISS, a leading proxy advisory firm, recommended shareholders vote in favor of Peltz's board nomination, citing the need for improved governance and strategic oversight. State Street's backing added further weight to Peltz's arguments, increasing the pressure on Disney's management. So, with Peltz's critiques laid bare, how did Disney counter this formidable challenge? A key part of Peltz's strategy was to secure board seats for himself and former Disney CFO Jay Rasulo. He argued that their presence would bring valuable expertise and a fresh perspective to Disney's board. Peltz highlighted Rasulo's deep knowledge of Disney's financial and operational intricacies, suggesting that his inclusion would help streamline and strengthen decision-making processes. However, Disney resisted these nominations, claiming that Peltz and Rasulo's involvement would be more disruptive than beneficial. Management argued that the current board had the necessary skills and experience to steer the company through its challenges. They contended that Peltz's aggressive activism could lead to instability, which wouldn't be in the best interest of the company or its shareholders. Disney also questioned the value of Peltz's proposals, suggesting that they didn't offer any new or innovative solutions. In response to the escalating proxy fight, Disney's management took steps to show their commitment to improving the company's performance and addressing shareholder concerns. CEO Bob Iger announced initiatives aimed at cutting costs and boosting profitability, particularly within the streaming division. He outlined plans to streamline operations, reduce unnecessary expenses, and improve the overall efficiency of the streaming business. Disney also emphasized a renewed focus on its parks business, which had been a significant revenue and profit driver. The company announced investments to enhance the guest experience and expand attractions to draw more visitors. This strategic shift aimed to leverage Disney's strengths and ensure steady revenue while addressing challenges in other parts of the business. Moreover, Disney committed to improving its content strategy, acknowledging the need for innovation and diversification beyond its established franchises. The company planned to invest in new intellectual property and take creative risks to maintain its competitive edge. This approach aimed to balance reliable, franchise-based content with new, original offerings to attract diverse audiences. Disney also defended the 21st Century Fox acquisition, asserting that it was crucial for strengthening their content portfolio and competitive position. They acknowledged the integration challenges, but emphasized that it was a long-term investment with significant future benefits. Iger consistently communicated with shareholders throughout this period to reinforce the board's dedication to enhancing shareholder value. He highlighted the steps being taken to address Trian's criticisms and reassured investors of Disney's long-term strategic vision. Now, you might be wondering, what was the result? In April 2024, the heated proxy fight between Nelson Peltz's Trian Fund Management and Disney reached its climax as shareholders cast their votes. Despite Peltz's aggressive campaign and detailed critiques in the Restore the Magic presentation, Disney shareholders chose to re-elect all 12 incumbent board members. This outcome was a clear rejection of Peltz's nominations and a significant setback for Trian's efforts to gain board representation. After the shareholder vote, Peltz sold his entire $1 billion stake in Disney, marking the end of his direct involvement with the company. Despite not securing a board seat, the increased stock price and heightened focus on strategic adjustments positively impacted Peltz's investment. By capitalizing on the improved stock performance, he realized substantial returns, showcasing his financial acumen as an activist investor. During the proxy fight, Disney's stock price rose by about 31%. This surge was partly due to Trian's campaign, which sparked renewed investor interest and confidence in the company's potential for turnaround. The pressure from Peltz and the media attention elevated the stock price as investors anticipated possible strategic shifts and improvements in governance. In response to Peltz's criticisms and the demands of the proxy fight, Disney's management implemented several strategic adjustments. They announced initiatives to reduce costs and improve profitability, especially within the streaming division. These measures included streamlining operations, cutting unnecessary expenses, and adopting more efficient content production strategies. Disney also renewed its focus on the park's business, recognizing it as a crucial revenue stream. They directed investments towards enhancing the guest experience and expanding attractions, leveraging one of Disney's core strengths. This strategy aimed to ensure steady revenue and mitigate financial pressures in other business segments. Moreover, Disney sought to revitalize its content strategy by investing in new intellectual property and taking creative risks. This balanced approach was designed to combine franchise-based content with innovative offerings that could attract diverse audiences. By doing so, Disney aimed to maintain its competitive edge in the entertainment industry and respond to the market's evolving demands. Although Peltz didn't secure a board seat, his campaign catalyzed significant discussions and actions within Disney. The company's management was compelled to confront its strategic challenges, leading to meaningful changes that aligned with some of Peltz's recommendations. Now, we're not sure whether Peltz will be back to try to take over Disney, but judging from the way he immediately pulled his money out, he may have already accomplished what he wanted, which was netting a profit for his capital. So, what do you think about Nelson Peltz's battle with Disney? Comment below, let us know your thoughts. If you enjoyed this video, give it a thumbs up and subscribe to our channel for more amazing videos.